Welcome everybody to Module 3, Session 4, the 30% Cash Rule. As we've been discussing, this is one of those items that will help you navigate your business through the tougher times and allow you to make mistakes as you grow your business. So this is a very key module that I want everybody to make sure you review this module. So, Session 3, 30% Cash Rule. What are we going to review? We're going to review how much cash you should have on hand and why. Now, you want to have this cash segregated. You're going to segregate your accounts in your operating cash reserve and tax reserve. Now, we've covered this previously in other modules, but we haven't gotten into as much detail as we're going to right now. As you recall, your operating account is going to be the cash account that you use for your operations, just like the name says. The cash reserve account will be the cash that is in excess that you need for operations that you want to earn some interest on. You just don't want to have it sitting there idling by, but you still need to have access to liquid funds. And then, of course, the tax reserve account is going to be the account that you set aside to make sure you pay Uncle Sam at the end of the year and you're not scrambling to make the payments on your tax bill. Now, these accounts, these are all cash accounts, and these are all separate accounts, either all at the same bank or at separate banks, whichever you so choose, but they're separate within your financial statements. Now, minimum cash on hand. You should have a minimum of 10% of your prior year gross revenue on hand in cash, but preferably 30%. So, do y'all remember this template? So if you recall, this template is in the bank reconciliation. If you recall, we went through how to do a bank reconciliation, how the outstanding checks and deposits, and how that affects your cash balance. But if you recall, down here was a calculation on the cash reserves. Again, here is that in this particular situation, we dropped in the prior year gross revenue, and we did a calculation as to this is the running total of the net income, and we said, okay, what's the operating reserve? And here we put the formula 30%. But again, you want a minimum of 10% in there, but in this case, this calculation was 30%, and then we had a formula that came through and did the calculation indicating whether or not you were over or under reserved. Again, this is a quick and easy calculation. So let's go back to the presentation. So why do we need to have 10% or 30% of your prior gross revenue on hand? You don't have to worry about timing issues on payroll. Now think about that. For those of you who do have employees, how many times do you stress, oh, I got payroll coming up next week, I got to make sure I pay my employees, because the second you don't pay your employees, they're gone, and then you're scrambling to cover for them. So that's always going to be a stressor for small businesses, is not only where do you get revenue, but how do you make sure you make payroll? Small problems go away. Now think about that. If you have 10% of your gross revenue in cash, or up to 30%, you have a cash reserve. If you run into an issue, a small problem that all of a sudden the motor breaks on the piece of equipment that helps you produce your widget, well, if you've got a cash reserve, you probably have the ability to go out and buy that new motor and fix it. It's probably a small problem, but it's an annoyance. It is an annoyance. But you're able to make it go away and keep running your business. You don't have to stress about, if you're strapped for cash and you have to replace that motor, otherwise you can't produce your product, what do you do to be able to make that happen? And then the next item, opportunity to make mistakes. Without the reserve, you have no room for mistakes. Now, I don't know about you guys, but I have, even though I've been in, did public accounting for 20 years and went through that process, and I saw so many financial statements, I still made mistakes in my own company. A lot of it was, trying to use a vendor that turned out they weren't quite what I wanted, and so I had to scrap that vendor, get another vendor. Well, when you have that cash reserve, you have that opportunity to make a mistake. And it could be a bigger mistake. It could be you're trying to produce a product and you thought you could produce it for $10 a widget, but now it's coming in at $12 a widget, but you can't increase your sales price. That cash reserve allows you to. When you don't have that reserve, you eliminate any room to make mistakes, and that obviously is going to be a huge stressor. So that's one of the big reasons why you want to make sure you have this minimum reserve on hand. Now, again, I understand, if you're a small business and you just started up, it's going to take you a while to get there. We understand that. Let's make sure we get you to that point. This is one of the goals that you want to focus on. Now, if you've been in business a while, it's going to be probably easier for you to get these reserves built up. Again, when you're building up the reserves, you think about that, that's cash that you're not going to be making a distribution to yourself or using for personal reasons. But think of it also as an investment. That helps you invest in not having to worry about having to cover payroll, about having that ability to make a mistake. That is so key. And 10%, think about this, is approximately 2 months cash. So if you have an issue with a supplier and you're having issues trying to get sales, you have that blanket, you have that cushion, you have that reserve built up. Now, 30% cash. If 10% is the minimum, then why 30%? Well, if you start up, you're going to need more access to capital. So if you think about that, is when you first start up, if you're competing against somebody who's been established, they've already been able to buy all their equipment, their assembly line, all the supplies, all the inventory. If you're starting up, you need to have access to that capital. If you have this, 10% versus 30%, you're able to make a major purchase, a transaction coming up, such as even buying out a partner. I mean, you think about that. If you are established business, you're a partnership, and you want to, let's say your partner just wants to call it, wants to retire, doesn't want to do anything, you have the funds to purchase that partner out. Economic times. How many companies have you seen in your life come out of recession stronger than other companies strictly because they had the reserves in place? I don't know how many times I've seen it in my career when I did auditing. There'd be a company that was doing pretty good. They're making money and net income and giving bonuses, but then the hard times hit. The recession hits, and then all of a sudden they don't have reserves built up, and they end up, and unfortunately I see this a lot, they end up cutting their fees, doing price cutting to try to keep business, and that's just a downward death spiral. You start doing that, you're just going to, if you do pull out of a recession, it's going to be very hard. You're not going to be in a strong position. Now, if you have the reserve built up and you have hard economic times, you're in a position not only to weather the storm, you're also in a position to think about this. You can purchase your competitor. You have the opportunity to, buy land. How many people in the last big recession saw a whole bunch of houses or rental properties or businesses, locations being sold a lot less than what they had gone for previous? Wouldn't that have been great to have that reserve to be able to take advantage of that? Or conversely, your competitor, if they don't have a reserve built up, but you do, you might be able to buy them out, and I hate to say this, you can probably buy them out at a reduced price. If they're struggling, they're not in a strong negotiating position. But if you have a huge reserve, you have a huge negotiating position. So those are the keys that you've got to think about with your business. Now, your operating cash. Now, your operating cash is going to be broken up into your operating cash, just your strict, bank or your checking account for your operating, plus your payroll account. Remember how we talked about your payroll account? You want that separate from your operating account. You're going to have those two accounts. Ideally, you want to have a cash reserve account as well, and you want to have a minimum of 5% in the operating, a minimum of 5% in the cash reserve, or 10% in the operating if you don't want to put anything in the cash reserve. But you see how those two, that 5 and 5, that equals the 10%. That's what you want to make sure you have. If you do use a reserve, you want to have at least a minimum of 5% in your operating, and then the other 5% can be in your cash reserve. Now, you want to have a maximum of 15 and 15 in both those. Again, you don't want to get too wild and crazy and having too much cash. 30% is kind of the max, unless you're thinking you're going to do a huge merger or acquisition of a competitor. Then you may want to do that, or if you're looking to get a large loan and you want to build up your balance sheet and make your current ratio. Remember, your current ratio is your current assets over your current liabilities. If you build up your cash, you're going to improve what your current ratio looks like. So that could be a possibility. Now, the cash reserve. Put the excess funds in a cash reserve account to earn interest. Now, I know a lot of you are sitting there thinking, I'm going to make like 0.1%. True, but that's 0.1% that you wouldn't be earning if it just sat in your operating account. So again, make sure you have enough in your operating account that you can fund your operations. But the cash reserve is to be considered, if you have that excess funds, make it work for you. Make those cash reserves work for you so you have the cash that flows through. Now your tax reserve. Now, again, not to beat a dead horse, but I've, was doing auditing for 20 some years, and I swear I've seen it so many times, especially with smaller companies, where at the end of the year they had a great year, but they didn't put money aside for the tax reserve, and so you guessed it. When it came time to write that check to Uncle Sam, they're pulling it out of their bank account, or they're pulling it from somewhere. Sometimes I wouldn't see where exactly they pulled it from, but they had to make the payment, so they had to pull from personal funds. So the tax reserve, this concept, this should be set up to be approximately 40% of your net income. Now, that accounts for federal taxes and state taxes, and so that kind of gives you a cushion there. Now, depending on your state and your federal tax level, this may not be enough, or this may be in excess. 40% is kind of the general rule for this, and the reason being is if you have 40% set aside, you for the most part are going to be covering most of the higher end tax brackets, with the exception of maybe some of the higher state income tax states. But this will help you set aside, and by that you're going to be able to make the payment. And if you have excess, hey, you can either roll it over to next year and use it for your calculation of 40%, or you can disperse it out if you so choose. The important thing is you will have to pay Uncle Sam on your net income, on your taxable net income. So set the money aside now. It's really not yours. Segregate it now will make it so much easier. It's just like the theory of when you first got your job and you started contributing to a 401k. You set it aside. You're not going to spend it. It's going to sit there and make retirement, at some point in time down the road. This is the same concept. It's going to help you down the road. Now, work with your tax accountant regarding quarterly payments to the IRS and your respective state if applicable. So, depending on what state you live in, you may have to make quarterly payments. Obviously there are some states that have no state income tax, so that's why I say talk to them. But your tax accountant, when they do your taxes at the year end, they will usually, most tax softwares will calculate what the quarterly payments need to be, and they will give you that. And sometimes they give you what's called a coupon. And at the end of every quarter, assuming you're a calendar year taxpayer, which I'm guessing most of you are, so at the end of March, you'll have a payment you need to make. At the end of June, there'll be a payment you make. At the end of September, there'll be a payment to make. And they will help you identify what these payments need to be. Now, we come across a situation. What if you're a partnership? You don't pay tax. What if you're an S Corp? You don't pay tax. Well, think of it as remember how when we talked about in Module 1 the concept of partnerships and S Corps being pass-through entities. Well, the net income from your partnership or S Corp is going to pass through to you. You're going to be paying that tax. So the partnership won't be paying the tax. You will be paying that tax. So when your tax accountant does your tax return, they should be able to go through and calculate the amount of tax based on the estimate that you'll need to pay quarterly. Because keep in mind, when you get that revenue, or that I should say that net income from your partnership, you haven't paid taxes on it. It's income coming into your personal tax return. So they will help you set up those quarterly payments. Now, some of you may be thinking, okay, if this is all pass through, why would I set up a tax reserve account on my partnership in business, or why would I set it up on my S Corp? think of it as, yes, it is a tax reserve, but it's going to be a distribution to you, the owner of the company. So if you set up 40% of the respective net income, you set it aside at the end of the year when you go to pay your taxes, or if you're doing quarterly payments every quarter, you'll draw out of that tax reserve account, and instead of it being a tax expense, it will go through and be considered a distribution to you, the owner. And so then from you, the owner, you then will write your check to the IRS. So that is kind of how that would flow through, but you still want to set up that reserve, because again, this isn't your money, and you don't want to overspend and get to April 15th, and let's say you had a great year, but then your tax account says rings up, say, hey, Jane Doe, you had a great year, you owe the IRS $300,000. I'm pretty sure a lot of you would, first your jaw would drop, but conversely, if you think about it, if you owe $300,000, it means you had a really, really great year from net income standpoint. But did you keep all that net income or all that revenue set aside, or did you pay off your house and pay off a bunch of debt type situation? So that's why it's key to keep that set aside to protect you. So to recap, you want to have a minimum of 10%, but a maximum of 30% of cash set aside in your operating cash reserve accounts. Again, it's so that you make small problems go away and you have the ability to make mistakes in your business. Tax reserve, you want to set 40% of your net income aside on your tax reserve. Again, it's so that it protects you so that you don't overspend. Again, I can't tell you how many times I've seen businesses that they dwindled their cash down, and when it came time for a sudden expense or an opportunity or to pay the tax man, and they didn't have the cash there, it really hampered their abilities to guide their business. Because keep in mind, what is your overall goal in your business? I'm assuming your overall goal in your business, one, it should be to have your business work for you. Well, to have your business work for you, you need to have the structures in place, the processes, procedures in place, and in this case, the reserves in place so that everything can function. Ideally, you want your business to be functioning at such a point that you can take a 2-3 week vacation and your business still runs. Now, you may have to call in every now and then to authorize a transaction or maybe talk to a vendor or something. But for the most part, your business runs. It still makes you net income. It's still going down the path you want it. And then the other thing is, most people either want to get to a point that they sell their business, whether it's in 5 years, 10 years, 15 years, wherever, or they want to pass it on to either their children or their estate or a spouse or partner, whoever. That's another goal. So to get to that point, again, you need to consider having those reserves in place. The next session that you'll be coming up on session 4, we'll be going over the internal controls, and in particular the internal controls over the cash flow cycle. So this concludes session 4. Please continue on to session 5 and listen to and review the importance of the internal controls over the cash cycles of your business. Thank you.